Welcome to Market Catalyst. I'm Julie Hyman, and here's what we're watching today. First up, we'll have full coverage of the November inflation report as the consumer price index shows signs of cooling. Plus, Micron's report results that blew past estimates, but is it enough to calm fears of an AI bubble? Maybe for today at least. And we'll get the outlook for electric vehicles next year amid mounting headwinds for that industry. First up, let's take a look at the major averages here in the wake of that CPI report. So year over year did show a much smaller gain of 2.7% than estimated, or at the core of 2.6%, but it was a noisy report. That's what we're hearing from economists and market participants. All of that said, it's enough to help the market rally, up 320 points for the Dow. That's about 2/3 of 1%. The S&P now up by more than 1%, and the NASDAQ composite is up by 1.4%. What's going on with bond yields in the wake of that CPI report? We're seeing them come down a little bit to 4.11%, perhaps reflecting a little bit of a changing outlook, bringing forward some of the rate cuts that are expected for next year. We'll continue to watch that phenomena. Bitcoin prices are trading lower, which is interesting, and not necessarily what you would expect if there are changing rate cut expectations. So that's something to continue to watch here. And then crude oil futures, just getting a check there because we saw that bounce yesterday on the president's new measures in the coast off Venezuela, and those continue to tread higher. Digging more into what's going on in stocks right now, here are the groups within the S&P 500. We've got energy actually lower, even though oil prices are a bit higher. Consumer discretionary, the best performing group today. Then you've got the XLK. That's where you will find Micron and its big move after its report, then industrial. So we've got really a cyclically led rally that's going on here today. And here's the NASDAQ 100, good equal weighted here, so we can get a better look at what is indeed going on with Micron. Now, Micron's trading up by 13% today, and that builds on the huge gains that it's already seen this year. Really a paradigm shift in its whole business model as it now shifts more towards high bandwidth memory. We're going to be digging more into Micron in just a little bit here, but you do see more green on your screen than not. If we look at the broader semi-complex here, you see all green here, so you've got a little bit of a halo effect happening as a result of Micron today. Let's turn back to the November Consumer Price Index. That CPI showed headline inflation rose by 2.7% from a year earlier. That's less than the expectations of 3.1%. Remember, this report is the first since September because of the government shutdown, which is why we didn't get month-over-month numbers from October to November. So let's dive into the report a little further here because we did get categories that had the highest and lowest rates of growth from a year earlier. Broadly, housing was up 3%. Food away from home up 3.7%. Food at home up 1.9%. Energy up 4.2%. Healthcare costs up 3.3% here. Diving deeper into the food at home category in particular, some of those specific grocery costs that we've been tracking very closely, like egg prices, were down 13% from a year ago. Beef prices, though, rose sharply in the month. We've been seeing low herds. That's been affecting dynamics. Beef prices up almost 16% here. Beef roasts up over 20%. Coffee prices, and this was a result of tariffs, which then were removed on coffee, but we did see coffee prices up 19% in November. Instant coffee, which has become more popular lately, up almost 25%. And prices for used vehicles rose slightly more than the broader index. They were up 3.6% from a year ago, but prices for new cars and trucks rose less than 1%. Some technology prices actually fell over the past year, including computer, software, and accessories, smartphones, and TV prices. As we've been talking about recently, though, those lower smartphone prices might not last because of the increase in memory chip prices, but we'll see how that plays out over the coming year. For more on inflation now and what could be ahead for the economy in 2026, I want to bring in Greg Dacko, EY Parthenon Chief Economist. Greg, it's great to see you as always.
Always a pleasure.
Man, I could use all of the words this morning that I've been hearing: confusing, murky, foggy, take it with a grain of salt. Those are some of the things I've heard to describe this morning's CPI report. What can we say about the report? What did it tell us?
I call it a Swiss cheese report. It's full of holes. We're missing a lot of data across the board. The main message, in my opinion, is the following. One, we have still a gradual pass-through of tariff cost onto CPI inflation and consumer prices. If you look in particular at the category that I focus a lot on these days, which is core commodities prices, core goods prices, when you exclude energy and food, that's rising at a 1.4% clip. That category usually deflates over time. It falls over time. So there is a pass-through here effect of the tariffs. On the opposite side, you have services less energy that are showing disinflation. These prices are rising, but at a slower pace, and that pace is about 3%. Now, it's twice as fast as goods prices, but it is revealing this deflationary trend whereby prices are rising, disinflationary trend whereby prices are rising at a slower pace. The key reason for that this month was that shelter cost disinflation is gathering pace. I'll put a big caveat there, as you just said. This is extremely noisy, and I think the shelter cost disinflation may be somewhat overstated by the methodology that the BLS use in the absence of October data.
Yeah, and that's something I've definitely been seeing a lot of chatter about this morning, Greg. When it comes to prices, obviously this is something that is really weighing on consumer sentiment. We see that reflected in surveys here in the U.S. And of course, the president spoke last night. He talked about prices. He addressed the issue of affordability, and he talked about bringing prices down. Now, you're an economist who has watched this stuff for a long time. What levers does the government have? And let's put aside the Federal Reserve for a moment. What levers does it have to bring prices down, or, to at least create disinflation, let's call it?
Yeah, so I think you're very right to point out that we do not want to see deflation, which is falling prices, because generally speaking, falling prices accompany a recession or a depression. So we don't want to be seeing that. What we want to be seeing is essentially an environment where most households feel they're able to spend, and that the affordability crisis that has been brewing is becoming less of a constraint. Now, there are two elements to an affordability crisis. We were talking a lot about prices and cost. The other element is essentially wages and salaries. If you have the wages that are rising faster than prices, that means that people have the ability to spend, even if prices are somewhat higher. And that phenomenon does not happen overnight. It takes time for essentially any type of real wage increase to gather momentum and allow for this affordability crisis to become less of a constraint on households around the country. So the answer to your question is that there isn't a simple lever that the administration can pull apart from one specific thing. Alleviating some of the tariff cost pressures would reduce the pressures on many businesses and reduce the incentive to pass on those higher prices to consumers. That is the key lever that can help alleviate some of these pressures. But in the broad context of all of the inflation we've seen since the post-COVID period, which is accumulating to about 25% since 2019, there isn't really a key mechanism to alleviate this affordability crisis.
It's more that people maybe just have to get used to it over time and make more, to your point. Let's talk a little bit about next year, because I think your note looking ahead to 2026 is interesting. You talk about three resilient but narrow pillars for the U.S. economy that are sort of delicate, right? That they're fragile, if you will. And these are the three that you point out, but walk us through this and why they're fragile.
Yeah, I call them the A pillars of growth, narrow foundation to economic activity. And the A pillars are: one, affluent consumers; two, AI investment; and three, asset price appreciation, stock market gains. Now, they're creating right now a virtuous cycle, because we essentially have affluent consumers who are spending in part on wealth appreciation, which is driven by stock market gains. You also have greater optimism about AI, which is leading to a lot of CapEx and OpEx investment in AI, which is also leading to stronger stock market valuations and feeding back into investment. You can see how this is all intercorrelated and leading to stronger growth in the US despite a number of headwinds. But there is also the risk that this turns into a vicious cycle. And I think that is really what we have to be very careful with in 2026. The risk of perhaps an AI-related bubble that might burst could lead to a stock market correction that leads to a negative wealth effect and a negative confidence effect for families across the country, leads to reduced investment and reduced hiring in a labor market that is already softening. Those are the potential risks to this economy. So yes, it's great to have this triple A pillars of growth that are supporting economic activity, but they also represent a narrow foundation which is where we have to be very careful and attentive to potential downside risk.
So all of that said, you're looking for 1.9% growth in the U.S. next year, which is roughly on par with the growth that you expect to see this year. So while you say it's a balancing act, right? It sounds like you're at least cautiously optimistic that we're gonna make it. We're gonna achieve that.
I think we will see average growth around potential next year, but it will be supported by this narrow foundation to growth. We will see consumer spending essentially at a moderate 1.5% pace. We will see greater investment in AI connected areas, not just those big players that invest in AI, but any firm that is leaning towards AI with a holistic strategy, with essentially the aim of integrating AI into their strategy, those segments will see stronger growth. But I think the defining characteristic of our outlook is actually greater polarization within economies around the world and between economies around the world. You're seeing the well-offs and you're seeing people with more funding abilities that are doing most of the spending. You're seeing businesses geared towards AI doing most of the investment. You're seeing stock market prices that are tied to AI that are seeing most of the gain. So we're still going to see more polarization, and I think that will be a defining characteristic of the outlook in 2026.
Greg, good to see you. I'd love to
Always
dig
a pleasure,
more
Julie.
into that last point the next time we talk. Thanks. Coming up, Micron is surging as AI memory demand soars. We'll dive into the numbers next on Market Catalyst. Micron shares are soaring after it topped first quarter expectations and issued a stronger than expected forecast for the current quarter, continuing to get a boost from AI demand. Joining me now, Paul Meeks, Freedom Capital Markets Managing Director. Paul, it's good to see you. I mean, this has been another extraordinary story in the semiconductor industry in terms of the change that AI has had on this business. What do you think about Micron and the sort of runway this now has?
I think there's plenty of upside in the stock. Now, would I buy a stock that is up 11% in today's session on the heels of this report last night? Probably not. But on any dip, this is an extraordinary opportunity because this is an industry that is an oligopoly, right? It's Micron and two South Korean players control about 90% of the share. As a group, they are acting rationally when it pertains to adding capacity. In the meantime, the high bandwidth memory business is soaring, and I'm contrarian here, but I think the AI infrastructure build continues for at least another year, probably two. And so I think there's upside in their earnings estimates, which are already annualized at about $34 a share to this name. So I think $300 is an achievable price target, and it may even go higher.
Well, and indeed, the company says that all of its high bandwidth memory is already sold for 2026. So they're certainly seeing that demand come to fruition as well. How does this sort of change the dynamics in the memory market? I mean, as you mentioned, it's an oligopoly. There are two other players. We've seen memory prices go crazy, not even the high bandwidth kind, the overall kind that goes into all kinds of devices. So what are some of the sort of knock-on effects in the industry that you're watching and other names that you're watching?
So I continue to like the people that are benefiting from the spend. I recently initiated coverage with CoreWeave, which is one of the neoclouds with a $100 price target. But believe it or not, I think there's upside in NVIDIA, Broadcom, Taiwan Semi, some of these companies that when I get pushback, what people will say, how can you possibly recommend NVIDIA after it's done so well for all these years? Well, it's because I see even more greatness ahead of them. And, some of these stocks, Julie, have come down quite a bit in the last couple of weeks. I think it's a good buying opportunity for several of the names.
I'm curious about the neoclouds in particular, Paul, because there have been some questions about that business model, right? That if you're, renting space from someone else, if you're trying to go out to the smaller providers as your clients, then maybe you're a little more vulnerable if there are chinks in the armor of this whole AI thesis. What do you think about that?
Another excellent question. The way I look at it is you have to look at these contracts that they are signing very carefully. In the case of CoreWeave, we have 5 and 6 year deals with well-funded folks like Microsoft and Meta, and they're paying 15 to 25% of total contract value upfront, so there's some initial cash flow. And so I think that even though some of these companies are levered, and CoreWeave, mind you, is highly levered, that they have a nice runway. And I think that over the next couple of years, their plans are set and they're funded by the most well-funded companies almost on planet Earth. And the other thing that's interesting about CoreWeave, it has an interesting deal with NVIDIA, which is also a 6% shareholder, in which if CoreWeave has any surplus capacity between now and April of 2032, it'll be sopped up by NVIDIA. So some people will say that's a quote unquote circular deal, but I actually like that deal a lot. And so I do think there's upside. Yes, it's speculative. Yes, they're highly levered, but I think that this is all under control as long as the spending from the big boys continues. And I think all these companies, when they announce their results in January or February, will confirm at least the 2026 capital expenditure spend.
Paul, are there any names that you would avoid right now that you do think bring higher risk, or the valuation is just too high that you don't think it's justified?
Well, I'm interested in the guys that are getting the money, not the guys that are paying the money. And I get a lot of questions about Oracle because it's down so far from the top. Can it be a better buy? I don't think so. Of the two majors that announced last week, I very much like Broadcom, very much do not like Oracle. And you have a number of these software as a service companies that were all the rage back in the 90s, companies like Salesforce.com. I'm not convinced in the AI era if they're not just disintermediated. They'll all tell you publicly that they're transitioning well to the AI era. I'm not so sure, so I stay away from them.
Well, Paul, that's a perfect segue, because coming up in the next hour, we're going to talk about Salesforce and Oracle for that matter. And you're certainly not alone.
Julie, I'm setting you up.
I appreciate it. Good to see you. Thanks.
Happy holidays.
You too. Coming up, we'll head back to the NASDAQ and take a look at some of the top analyst calls on Wall Street with Brooke DePalma. Plus, we'll discuss why fixed income and not necessarily mega tech could be a better place for your money over the next several years. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Micron, General Motors, and PayPal. First up, Micron. The company said we are already more than sold out of high bandwidth memory through calendar year 2026. That forecast, well liked by Wall Street. Bank of America raised its rating on the stock to buy from neutral and its price target to $300. Plus, the analyst said it likes its increasing data center mix and exposure, longer-term agreements, cash flows, and potential resumption of buybacks. Wolfe Research also raised its price target to $350. Keep in mind, though, the average 12-month price target on the street is now at $296. Next up, General Motors. Wedbush analyst Dan Ives raised its rating on the stock to outperform as the company navigates what he called macro storms heading into 2026, with a focus on driving cash flow growth through its internal combustion engine business. That's ICE business. He also said it's executing better than its auto peers who have struggled in the EV transition. He believes CEO Mary Barra and the team are prepared for all options on the table. There are currently 18 buy ratings, 10 holds, and 2 sells on the street. Lastly, PayPal. Morgan Stanley downgraded its rating on the stock to underweight from equal weight. The analyst cited concerns that improvements to its branded checkout integration have been slow and are proving to be way more complex and time-consuming than initially expected. They also aren't moving the needle like the firm had initially hoped. Now, this comes after other firms like Bank of America and JP Morgan also downgraded the stock earlier this month. There are now 18 buys, 26 holds, and 6 sell ratings on PayPal on the street. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
As we look ahead to 2026 and beyond, one of the world's biggest asset managers says individual stocks, and most notably mega tech, may not be the strongest risk-reward investment over the next 5 to 10 years. Instead, maybe keep your eye on U.S. fixed income. Joining me now, Joe Davis, Vanguard Global Chief Economist and Global Head of the Investment Strategy Group. Joe, it's good to see you.
Yes.
And I just want to dive right into those recommendations because I think that's so fascinating. Instead of the traditional 60 stocks, 60% stocks, 40% fixed income portfolio, you're flipping that for the next 5 to 10 years. Why?
Well, it's really around risk management. You have to think about, the markets have been, exceptionally strong, particularly in the technology field. But whether you are pessimistic or optimistic on AI, in fact, either one, it'll start to push you outside of technology. Fixed income, more of a defensive if you believe AI is over exuberant. But the interesting thing is there's opportunities outside of tech, even if you're bullish on AI. And that's probably the strongest recommendation and conviction we have.
So let's talk about those opportunities outside of tech, and then let's circle back to the fixed income and defensiveness. Is it a matter of seeing how AI is going to then be deployed throughout the rest of the economy?
Yes, and what we found, we looked over 100 years of market history. What happens, and it takes a little bit of time here. It's not any transformative technology, electricity, the car, or the computer. What happens is it goes from the technology production to the consumption, the users. So AI, it's making value-based companies more productive if it's truly is transformative. And so there's a rotation that occurs in what some would call the value space, and it's really exciting. And these are parts of the market that are not nearly as rich as the technology field. Of course, if there's also risk of overvaluation in tech cycles, which is where it leads you to a little defensiveness in fixed income. So again, you don't have to make a stance on whether you think AI is a bubble or not. That's actually the really powerful insight from our research.
Okay, so let's come back to then that 40-60 instead of 60-40. And why now is that time that you want to make that shift?
Well, again, this is around risk management and narrowing outcomes. If you can think about just not being too overextended in tech, that's good on the equity side. However, as we best estimate, there's still roughly a 30% chance that AI does not evolve to the heady expectations. And so that's code word for, extended period of equity market disappointment. And so fixed income is a defensive posture for the probability that could happen. Effectively, AI plateaus and disappoints. And so we're trying to think about both of those scenarios. AI still could be transformative, which pushes you also outside of tech. And so from a risk management perspective, it's actually a fairly compelling and robust investment proposition that we have for investors.
Joe, I'm envisioning you saying this to a retail investor who has been driven by FOMO the last few years, right?
Yes.
And guess what? If they weren't in the market, they would have missed out. If they weren't in growth, they would have missed out, right? Because we have seen such a dramatic outperformance. So how do you convince that investor who has been so over-leveraged to that area, and it's worked, by the way?
Oh, totally.
That maybe that's not the place to be. How would you sort of spell out the risk?
Yeah, and again, this is no one has made any mistakes or missteps. What this is not looking backward, looking forward, and really I would think about it in terms of deploying new capital. So you have new funds going into your retirement plan. You may think about rebalancing. The fact is, most investors, because of the strong stock market, probably have more risk today than maybe they would have expected 5 years ago. That's good news today. And so just thinking about, repositioning at the margin with new capital to get I think this is an offensive strategy as much as a defensive one. This is about, if AI is truly transformative, the rotation and leadership of the market ultimately changes. We've seen this without exception in every technology cycle, from the internet all the way back to electricity. And so I think and you have some time on this. So I think that's an interesting thing to contemplate for 26.
And beyond, I guess, if we have some time on it also. And how, when you look at your expectations here and your assumptions,
Yes.
What are you pricing out, or what are you incorporating in terms of how many more times the Fed is going to cut and how far interest rates are going to come down?
Sure. We only have modest easing. We do have some easing to take out some insurance. One or two cuts by the Federal Reserve end of this year and next, because the labor market is clearly softened. But we do not have a recession as a baseline. And our thesis for over 2 years has been, we're in a more permanent, higher interest rate environment over the rate of inflation. That is good for fixed income, and so that's been certainly a theme for us, and I think that remains when we look ahead. So that's a positive balance, and that's clearly different where we've been the past 20 years. And so with the equity markets, at least in the U.S., a little bit heady valuations. It's something to relook at, whether you're in the munis or in taxable. It's both defensive as well as offensive, just given some of the income in these funds are much higher than they have been in the past.
And Joe, if you think that rates are not going to come down as much, maybe inflation is going to be at that higher for longer rate.
Yeah.
What does that then imply about the K-shaped economy or the affordability crisis, whatever you want to call it, and the durability and strength of consumer spending going into next year?
Sure. I mean, in fact, for 2026, I think you have headline or headwinds. That's clearly tariff and inflation related. And that's going to be a push and pull versus the upside of AI-related investment and that velocity. In our calculations, AI will start to pull ahead in the back half of the year, but we're not out of the woods. And so it's not, we don't, I hear in terms of there is impairment on parts of the consumer, parts of the country, manufacturing. And so it's not all good sailing for the U.S. economy. But when you do the calculation and the math, the risk will start to emerge, if we're right, in the back half of the year, some modest upside risk. But we won't see this right away for growth. We still have this inflation that's still running, to your point, a little hot, but it should come down.
And I know that you, as you mentioned, you've followed technological changes very closely. Yep. You wrote a book about AI and mega trends. And it feels like most people are sort of hazarding a guess now as to how this is going to play out over the long term. But as somebody who's steeped in it, what's your best guess as to what the U.S. economy looks like 5 years from now, and some of what those AI transformations could look like?
Well, the most likely scenario is that we will have growth that's higher than expected. AI will turn out to be more disruptive as well as transformative, at least as disruptive and transformative as the personal computer and the internet. Think of the late 90s. That's not to say everyone wins in that transition. There will be some automation, some job loss, but we have to balance that with a demographic profile and aging of society. So when you balance it all together, that's the most likely scenario. But AI has to continue to advance. We need to see considerable more investment and deployment.
More investment.
Yes. And with that will come misinvestment. There's no doubt about that. History is very clear. But it goes with the territory of having transformative technologies. I think companies, by and large, are making informed decisions on their own business model. It's just that when you add it up, 5,000 new companies, AI-related companies over the past 4 years. That's a massive amount of creative destruction, and not all those companies will win. And that's what's generally lost in the stock market and what happens. And so, again, we're generally optimistic, but I also don't want to, everyone will not benefit from this technology in upside and becoming more productive. There will be some disruption in some occupations, but the alternative is stagnation and not having that lift from growth. So and we're going to be in that environment in the next 2 or 3 years.
Really interesting stuff, Joe. Thank you so much.
Thank you for having me.
Coming up, the biggest brand moments from 2025 that investors could not ignore. Stay tuned. You're watching Market Catalysts. Brands found themselves in the middle of some big moments in 2025, from value-driven boycotts to free speech controversies and even viral memes shaping marketing strategy. Yahoo Finance's Josh Lipton spoke to Marcus Collins, marketing professor at the University of Michigan Ross School of Business, about what we learned and what investors can look out for going into 2026.
Marcus, always great to see you. So let's dig right into this, Marcus. The trends you call out here in 2025. One is the politicization of the product. High level, Marcus, walk us through that, explain it for us. What do you mean, and what are some examples?
Well, you think about Sydney Sweeney and American Eagle, Cracker Barrel changing their logo. It signals to the fact that what we consume is a signal of our cultural subscription, what we believe, where we subscribe our identity, and even our political affiliation. And as these commercial entities become politicized, our consumption becomes a vote on where we sit on each side of the aisle. Right. So what was normally considered something as trivial as what jeans you're wearing, because of the advertising, it now signals either you see it as a dog whistle for eugenics, or maybe it's just a double entendre on the word jeans. Which one is it? It all depends on who you are and how you see the world. It's not a benign consumption anymore. This is a way of saying who you are and where you sit on the political aisle.
One question, Marcus, I have, you're listening to this right now, and you're an investor. How does an investor try and distinguish between, Marcus, short-term drama, short-term outrage, versus, okay, hey, this is actually something longer term. I think maybe real structural brand damage is being made here that could result in real financial repercussions. I mean, American Eagle, you brought up, I think is an example where, listen, if you were an investor and you were watching these headlines and the pitchforks coming out on social media, maybe you got spooked, Marcus, but if you had gotten spooked and bailed, well, you miss out on a stock that jumped about 65% this year. It's up about 175% since the Sydney Sweeney ad came out. Any advice, Marcus, about how you try to distinguish these things?
You got to read the cultural tea leaves. Because with the Sydney Sweeney American Eagle debacle, while it was certainly controversial when it first happened, unfortunately, Sydney Sweeney actually took the biggest hit. Like all the movies, she had 3 movies that came out after this campaign launched, and they all tanked in the box office. And even her sort of space in the cultural zeitgeist has been tarnished. American Eagle kind of benefited from her getting the hit. So for an investor, you've got to be really, really close to this. You can't look at the activity on the surface. You got to get a sense of how is the culture, how are the people, how's the populace making meaning of these situations. Sure, on the surface, it looks like this is about like some racial tension that's happening. But at its core, people are making meaning. What do these brands mean? In the case of Sydney Sweeney, you had 2 brands at play. You had her, the actress, a personal brand. Then you had this denim brand known as American Eagle. And they kind of left this thing a little unscathed relative to Sydney Sweeney's position in all of it.
Marcus, here's another thing you call out, the cost of free speech. Walk us through that one.
Yeah, I mean, we saw with Jimmy Kimmel, his, being censored and essentially kicked off the air because of the political blowback of some comments he made about the execution of Charlie Kirk. And what we saw here is that there was so much political pressure on ABC of the Walt Disney Company to censor one of their most high-profile talent. And what we saw here is that while there is a want for control in this particular backdrop, in society, the zeitgeist still has a very strong affinity for freedom. And in all of these cultural happenings, these brand moments, it's really just a tension that we're at play with. With regards to Jimmy Kimmel, it's control versus free speech, right? With regards to Sydney Sweeney, American Eagle, this is about commerce and political identity. These things are constantly at odds with each other. And for investors, as well as for marketers, we have to find where we sit on that spectrum, because its impact and its result on business is pretty substantial, as we saw in this past year.
When a brand, Marcus, decides, okay, we're going to distance ourselves from this voice, I'm going to do that publicly, does that, Marcus, in your experience, how does that often end up for the brand? Does that decision, does that reduce risk, or does that often make everything worse?
It always depends. That's always the right answer in business. It depends. It really does depend. It depends on how convicted the company is in its beliefs and how it sees the world. Clearly, we saw that the Disney company was willing to sort of walk back its original stance of moving Jimmy Kimmel off the air once they got pushback and feedback from the audience. When it comes to making decisions, what I always tell brands, always this, is that make decisions based on conviction, not on convenience. Choose conviction over convenience every single time, because there's always going to be trade-offs either way. But at least the trade-offs that you make are in line with how you see the world as opposed to how you think things are going to play out.
Marcus, we're always lucky to have you on the show. Happy holidays, my friend.
Same to you. Appreciate you.
Coming up, we'll bring you the outlook for electric vehicles next year as headwinds mount for the industry. The electric vehicle industry is facing mounting headwinds. Among them, the expiration of EV tax credits here in the U.S., President Trump rolling back fuel efficiency standards for vehicles, and the European Union backtracking on its combustion engine ban. Joining us now, Itai Micheli, TD Cowen equity analyst. He covers automakers. Itai, this year really felt like an important one for the electric vehicle industry, and not necessarily in a good way. In your view, have we seen a really fundamental change in the not only the policy support, but also the consumer demand for electric vehicles?
Absolutely. Thank you for having me. In the near term, there's no question that the demand environment is going to be challenging. Companies generally expect EV adoption to equate to about 5 to 7% of new vehicle sales over at least the very near term. But our message over the next couple of years is don't sleep on the U.S. EV market. While the near term is likely to be pretty difficult and there's not a whole lot of visibility over the next few months, there are a number of tailwinds that we still think are out there that do kind of provide a more of an optimistic backdrop over the next couple of years. So I think we're still optimistic in the next few years that EV adoption can grow. And to your point, a lot of it will be driven, as it has in the past, really by consumer demand as well as new product.
Okay, so you've got a couple reasons to be optimistic. Let's go through them. What do you see? What are the indicators of consumer demand that you see that there still is that desire for EVs? Because we've seen hybrids really take off in a different way, in an accelerated way, but that hasn't necessarily been happening from the EVs, and we've seen car makers pull back from their plans.
Absolutely. There's three reasons to be more optimistic over the next couple of years. One is, let's not forget, the U.S. is a very dense auto market. We have on average about 2 vehicles per household, higher than any other country. And so the burden of EV adoption is simply having more consumers kind of wake up and conclude that you can have the best of both worlds if one of your vehicles is combustion or hybrid and the other one an electric vehicle. If you were to start to see more consumers make those decisions, and we are seeing that in some regions in the U.S., you can model a very robust, decade or more for U.S. EV sales and still be left with a society that has one EV in the household and then one combustion or hybrid in the household as well. That's a very overlooked tailwind that we could have structurally as a country over the next few to several years. The second reason is that when you look at loyalty of EVs, meaning what are current EV owners doing when they're coming back to market, they're still buying EVs at a higher clip than what we're seeing in other propulsion systems, including hybrids. And so EV to EV loyalty being that high is a sign that we're not really seeing consumer regret or people kind of really turning back from their prior EV purchases. Once you buy an EV, it's pretty sticky. And the third reason really is product. Even though we have seen automakers pull back in the near term, we'll see probably even more restructuring actions. There still are a lot of investments in next generation products, and we can't forget that EVs are innovating still at a pretty rapid pace where every generation is better and cheaper than the prior. So think of upcoming vehicles like the Rivian R2, of course, Tesla's Cybercab, even Ford, right, making their mid-size truck investment that will launch in 2027 at a $30,000 or so starting price, and GM making their investments in next-gen batteries and product as well. And within that, the final point is autonomy. We are very bullish on consumer autonomy in the next few years, and autonomy does tend to kind of relate itself well with EVs. And so if autonomy does pick off at the consumer level in the next few years and really kind of pick up, you're going to see potentially a tailwind to EV adoption off the back of that as well.
Itai, I want to take the last point you made and dig into that a little bit more. I mean, you mentioned Ford coming out with that new pickup. Of the better and cheaper, isn't cheaper a lot more important than better at this point? Is that the thing that really needs to be unlocked in a more dramatic way in order to drive more adoption?
Absolutely. And it's really all of the above, right? Solving some of the prior pain points, whether it's more EV charging infrastructure, frankly, more product. We still have some segments that are underserved with electric vehicles. Of course, lower priced EVs are very, very key, but also higher range and continued performance improvements as well. And that's really one thing what we learned about the EV market in the past 5 years. Every generation does tend to be significantly better, and to some extent, lower cost, lower price as well. So the next few years, as we look at what's coming out, that trend is still alive and well of better and more affordable EVs, including in segments that have been kind of underpenetrated in the past several years. Right. One thing we shouldn't forget is that the EV market in the last 5 years in the U.S. arguably hasn't really been a true market, right? It's just a handful of nameplates, of course, Tesla being the most successful, but there's still a lot of underserved segments and vehicle styles, and those are still kind of coming based on what we know on product launches.
So who do you think are going to be kind of the winners and losers here? Or do you think that this is something that most of the existing automakers, both the EV natives and the OEMs, can kind of access?
Sure, yeah, certainly Tesla sort of leading the way, particularly on consumer and broader autonomy. So we're watching for the Cybercab launch and rollout next year. That's going to be very important. We talked about Ford's launch in 2027. We'll see what GM continues to do. They have still a wide portfolio and enough capacity to kind of adjust to market demand, and they'll have, of course, new technologies as well. So ultimately, I think there's still a lot of opportunity for many automakers to address. Of course, in the near term, the key is to match production with demand. You don't want to have situations where you have too much inventory and then incentives and pricing start to come off. And so it is important in the near term that we end up establishing a healthy EV market. But again, in the next 12 to 18 months, we do see a number of tailwinds that could positively affect a number of industry players here.
Itai, I have a question about autonomy also. You mentioned a moment ago that EVs are sort of better suited to it. But can you AV anything? Like can't you make any kind of vehicle autonomous? Why are EVs sort of better suited for it?
Yeah, it's a good question. You can. Certainly, you do see combustion vehicles that can become fully autonomous. But what we're told is it is easier to some degree, right, to kind of put an autonomous vehicle on an electric vehicle system. So our view is, some of the more advanced consumer autonomy vehicles are, of course, EVs. If you look at what Tesla's doing, what Rivian's doing. And so we think as those sort of, kind of start to ramp up volume, that could create more momentum around autonomy. And our expectation would be that would actually help drive EV demand, particularly if the automakers have to play catch up pretty quickly. At that point, you could argue that an EV that's autonomous would be sort of easier to roll out fairly quickly as you're trying to build these autonomous capabilities, presumably rather quickly to chase some of the initial leaders out there.
Interesting. Itai, great stuff. Looking forward to seeing how it all plays out next year. Thank you.
Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here, we see a rally underway that's actually extending here, taking another leg higher. The Dow right now up about 417 points, about 0.9%. The S&P 500 gaining about 1.25%, and the Nasdaq up 1.8%. Two things really working in the market's favor today. First, of course, we got consumer price index in numbers this morning that came in better than had been expected, even though all the caveats here that it was a murky number because of the vagaries of the government shutdown. And then you had Micron really coming in and blowing away estimates. So those shares are higher, as are shares more broadly across the semiconductor and to some extent the tech complex as well. And speaking of tech, Salesforce is one of the worst performing stocks in the Dow Jones Industrial Average this year. Shares down more than 22% in 2025 as the company faced concerns about AI's threat to its software, pressure from activist investor Starboard Value, and as its AI monetization lags. So we're taking a closer look at the company as part of our Down Bad series. Joining me now, John DiFucci, Guggenheim Securities Senior Research Analyst and Senior Managing Director for Software. John, it's good to have you here because man, Salesforce has had a year. And it's been, Mark Benioff's really been trying to turn the ship around, but investors are definitely not convinced here. What to you is sort of the biggest thing that Salesforce needs to do to turn the narrative?
Hi, Julie, and it's great to be here. Most people think what they have to do is monetize AI. I don't necessarily think they're ever going to be able to do that. They have to embrace AI, and it's got to be part of what they do. Every traditional SaaS application vendor has to do that to make their products better, like they do every year. But they're probably not going to be able to monetize it because everyone's going to have it. So what I think they have to do is they have to do a better job of selling to the enterprise, and with good AI. Now they came out with Agentforce, as you know, a little more than a year ago, and it really hasn't done well because they had more marketing than they had product, and now they're trying to catch up on the product. But even if they do, I don't think they're going to be able to monetize it.
And what do you think broadly? I mean, this applies to Salesforce, as you say, but it applies to the whole software complex. I mean, are companies not going to turn to those sort of purpose-built solutions that these software providers are trying to give them? I mean, are they going to go straight to the LLMs, which are going to be giving them those solutions?
Yeah, there's this idea out there that everything comes full circle to everything being custom applications again, instead of packaged applications. I don't necessarily think that's in the cards, at least not anytime soon. AI is just not ready for that. And we'll see, maybe in 3 to 5 years that happens or it starts to happen. But I still think there's going to be a lot of companies that want a packaged application that builds upon best practices across the history of those companies, those packaged apps companies. So I still think there's room for these traditional application vendors. But if what you say even happens partially, it does have an effect on their relevance, right? They're very relevant today, or they have been up until recently. There's a lot of questions, but it will have an impact on the relevance going forward.
And John, the company made a big acquisition in the form of Informatica. What has that done for them? Because I know you pointed out in a recent note that there's just not the clarity that you would want around the financial contribution from Informatica.
Yeah, so what Informatica does, we don't think it does a whole lot for them, okay? It's not like Informatica did have a modern platform, but they also had a legacy business, an ETL business, which was the primary business of theirs, being able to integrate different kinds of data but it's mostly for structured data. If you really want, and they claimed Informatica was going to be this big AI play, you really have to integrate all kinds of data. Not that Informatica can't do it, it's just that is not what they primarily do.
Sorry, and John, just explain to me and to the viewers, what do you mean by structured data?
So structured data is the kind of data that most enterprise applications use today. It's data that can be used in a relational database. It's about 10% of the data out there. It is the data that for all applications used up until recently, because managing unstructured data like video files or pictures or things like that was just really difficult. The cost of doing that was greater than the value you got out of it. That's changed. Technology advances have changed that. Informatica has changed too, and they can manage unstructured data, but that's not primarily what they do. What I think Informatica does for Salesforce is they just buy some growth. I don't think it actually provides a ton of strategic value for them.
And so, okay, put all this together. What are the chances that Salesforce rebounds next year?
There's always a chance, and if you listen to them, they're very, very good at messaging or promotion. I don't think it's a great chance. I think there's just as much a chance as Salesforce's relevance continuing to moderate, and their growth going from, low double digits, which is what it's been not too long ago, to high single digits, to mid single digits over time. And they're, unfortunately, I think that's it. That's just as likely to happen as them rebounding.
So, John, I want to leave by talking about what you do think is going to do well next year, what your pick is for next year. And I got to say, this one surprised me, John. I'm talking about Oracle. You think Oracle is going to bring it back next year. As you know, there are a lot of doubts in the market about this one. What do you think people are getting wrong?
Listen, there's a lot of doubts in the market, and they have to do with debt investors, too. So and by the way, I've covered equities my career. So this is a little bit new to me, too. And I understand the customer concentration with OpenAI, and there's some questions around that and how they're going to pay Oracle over time. That's real. But the reason we're so positive on Oracle is because they just have a better mousetrap. Their cloud infrastructure is better than anybody else's out there. They provide a service with better performance at a lower cost, and they're still comfortably profitable. So if something happens along the way to some of their customers, which they don't anticipate, and I don't necessarily anticipate, I actually believe AI will progress and will be perhaps the most important advancement in technology in my lifetime. So I think that that'll be fine. But even if it doesn't, even if a customer of theirs sort of has issues, there's enough demand out there, and Oracle's going to be the first choice for AI infrastructure, or any infrastructure it should be. We'll see.
We will see. John, we got to leave it there. Happy holidays. Hope to catch up with you about all this in the new year.
Thanks, Julie. Same to you.
Thank you. We got much more markets action. Jared Blickery is coming up next with Stocks in Translation.
America loves a comeback story. So on today's Stocks in Translation, we are breaking down 11 2025 S&P 500 winners for you. But the twist is, many of these are still working their way back from pretty deep holes. Methodology-wise, we took all the S&P 500 names that were down at least 25% in 2024 and up at least 25% this year. And we discovered a few themes to track for next year. First, let's look at the comeback leaderboard, and it is a wild mix here. Here we have the first 6 names sorted by 2025 returns, beginning with Paramount Skydance. You can see it in blue, and it was down about 30% in 2024, and the orange bar is showing it's up 25% this year. Its merger drama this year is ongoing, and we're going to get into all the company stories in a minute. For now, just note the mix of industries, from auto parts supplier Adaptive, steel company Nucor, well-known luxury brand Estee Lauder, chemical company Albemarle, critical for lithium production, and animal health and testing company IDEX Labs, which is up nearly 70% this year. And in this second group of names, we've got America's largest military shipbuilder on the left, Huntington Ingalls. It's up a cool 70% year to date. Then discount store Dollar Tree, followed by pharmacy giant CVS Health, chip maker Intel, which is up 80% this year, along with another discount name, Dollar General. Now let's look at all of these names together in a heat map. And we have all of these set for year-to-date returns. And a quick note first, most of these names are still down over the last 2 years, with the exception of CVX, Dollar General, IDEX, and Huntington. So let's talk about some of these stories. First up, we got Intel. Now, this company is up 81%, and it's the poster child for a comeback that's still not fixed, because you had a really tough 2024, then a monster move over the last few months, and I'm going to show the year to date here, but over the last 2 years, still underwater. So the 2026 question is simple. Can this turnaround turn into execution? Products, manufacturing, and proof, not just headlines. Next up, we have CVS, up 74% this year. It's a great example of a stock that got punished on a fundamental problem, medical costs and guidance drama. And then it got a relief rally when the story stabilized. Year to date, it's up big, but over 2 years, it's basically a small gain. For 2026, CVS is a market signal for healthcare cost inflation, and if that trend gains steam again, it can hit more than just this one stock. Next up, we have Dollar General, DG, up 81%. This is your consumer mood ring. It's up huge this year, and it's also slightly positive over the last 2 years. The 2026 tell is whether margins hold up when promotions, shrink, and cost pressures, they start pushing back. Because when value retailers get squeezed, the rest of consumer land can feel it too. Now on to Paramount Skydance. That's up 26% this year. And the story here is deal drama, transition, and then a fresh re-rate on a new company narrative. It's up this year, but very volatile, and now sits in the red over 2 years. So the market is interested, but it's needing a resolution on who finally owns this company and some other things. So 2026 is about whether they can execute on the new plan without all the old problems creeping back in. Finally, our smallest company here, Huntington Ingalls. This is the sneaky one that adds some spice because it's not a retail or a tech story, it is a throughput story. It was up strong in 2025 and also up about 27% over the last 2 years. For 2026 next year, the big question is whether they can turn backlog into deliveries and whether labor and supply constraints get better or they stay sticky, which matters well beyond the defense industry. Now let's talk about what to watch based on this 2026 list. And we got a few themes here. Think of this as an early warning dashboard for the broader market. The first category to pay attention to is guidance credibility. Watch CVS, Dollar General, Intel, and Paramount. If these companies can hold guidance or raise it, it's a signal that demand and cost, they're behaving. If they start walking it back, well, that's often how earnings season starts going sideways. Then we have margin durability. Watch Dollar General, Dollar Tree, Estee Lauder, CVS, and Nucor. Margins are where all the real world stuff shows up first. Discounts, wages, input costs, and margin surprises can move the entire tone of the market real fast. Next up, we have consumer stress and trade down. Here, watch the same basket as above, except take out Nucor. Because when value stores are booming and discretionary categories are on the back foot, that is a different economy than when everybody's spending like it's peak pandemic stimmy time. This group helps you see that shift in real time. And finally, last on the list, we have cyclical pricing and the real economy pulse. And for this, we're going to watch Nucor and Albemarle. Steel and lithium can be messy, but they're useful because when those cycles turn, they often tell you whether growth expectations are heating up or cooling off. So all in all, while these are the comebacks of 2025, next year is about which ones can prove that it's been more than a technical bounce. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Trump Media Group has agreed to merge with Tay Technologies, a closely held developer of nuclear fusion, in an all-stock deal valued at $6 billion. The deal marks a dramatic pivot for the social media company as it looks to capitalize on AI's growing demand for power. Joining us with more is Yahoo Finance's Jake Conley, because I'm sort of an energy tourist. Jake lives there, right, in that kind of world, and you think a lot about these issues. First of all, to set the table, this company is looking into nuclear fusion
power
versus nuclear fission, which is how existing nuclear power works.
Correct.
Fusion is not commercially viable yet, right?
It's never been
talk
commercialized.
to us about that.
Never been commercialized. Fission, which all the nuclear reactors in the world currently run on, same thing for the SMR, small modular reactor, plans from Oklo or nanonuclear. This is all fission. You're taking heavy atoms like uranium, ripping them apart to generate energy. Fusion is the exact opposite. You take light atoms like hydrogen, shove them together. This has been done in labs under very controlled conditions for very brief moments, generating tiny little bits of energy. It has never been commercialized. And there's a joke in the nuclear industry that we are always 20 years away from being 20 years away from fusion power being viable and commercial.
Although some people say we are getting closer.
We are.
The question is how close. Now, in the statement today announcing this merger, they say in 2026, for those watching at home, that's next year, the combined company plans to site and begin construction on the world's first utility-scale fusion power plant, subject to required approvals.
Subject to required approvals.
Like, is this even if it had nothing to do with approval, is this even happening from a technological perspective?
Likely not, just because the technology's not there yet. But you cannot discount the regulatory hurdle here.
dealing with nuclear energy, dealing with any of this new age energy development is extremely regulatory intensive. I'll give you an example. You look at NuScale, which is proposing to build an SMR, right, using fission technology.
Small modular reactor, as
exactly,
you said,
yeah. Fission technology, it's understood. They started discussing their plans with the Nuclear Regulatory Commission in the mid-2000s. They did not get design approval until 2023. It's roughly 15 years. The agency has not even come up with a framework yet for regulating fusion. That is still in process. They're hoping to have that done in the next couple of years, but that means you really can't approve anything until you get that framework. So breaking ground on 26, while they may do site selection, I think is a bit of a stretch.
And just to remind folks, Trump Media Group is majority controlled by a trust in President Trump's name. It is managed by Donald Trump Jr., so obviously controlled by him. He has been a vocal bull on nuclear. Mm-hmm. So does that then tip the scales from a regulatory perspective? But as you say, they don't even have the framework yet.
They don't even have the framework there. Could this happen quickly? Sure, maybe. If there is a ton of money behind this, if there is a ton of support, if the NRC throws all of its resources behind this.
Okay, let me pause you right there. Does Trump Media Technology Group have a ton of money?
No, which is one of the things that confused me here, because they're citing balance sheet support as what they're going to do for TAE. But Julie, as you and I have talked about, TMTG has struggled with revenue, it's struggled with profitability. Doing R&D, research and development on these kinds of projects, this is multi-billion-dollar capital outlay. To date, TAE has raised about $1.3 billion from Chevron's venture capital arm, from Google. There is serious big tech support. However, moving that fast is going to be really hard, even if you had billions and billions of dollars to kind of blow on R&D expenses.
All right, well, we'll see how it all works out. Thanks, Jake.
Thanks, Julie.
Well, Starfighter Space is now trading on the New York Stock Exchange after raising $40 million in its IPO. It's an aerospace company that operates the world's largest commercial supersonic aircraft fleet. Joining me now is Rick Svetkov, Starfighter Space CEO and President. Rick, thanks for being here. Congrats on the IPO. Talk to people about what you guys do. Explain to the audience and potential investors what Starfighters does and how that supersonic jet works in the space ecosystem.
Absolutely. We've been a long-standing company. We started 30 years ago, and we've been at Kennedy Space Center for the last 20 years now. We started out as a demonstration team flying at military air shows, and for the last 20 years, we've been working on research and development operations. We've carried a lot of different items, anywhere from detecting the high-altitude dust particles that come in across the ocean, and to see if there's any pathogens in them, to now we are developing, helping to develop the hypersonic levels of operations. Next operations for us will be clearly the shots to low Earth orbit. We're already in development of new rockets, and we have a very exciting program that we're establishing now for the future.
And so just to make sure I understand, do you have these jets in operation as of yet, or this IPO is going to help the funding and get you guys to that next step?
No, we actually have operational jets currently flying daily out of Kennedy Space Center right now.
And why did, given that, as you say, you guys have a longer history, why now for that initial public offering?
Well, it's kind of interesting. Basically, what we did is we started out as a demonstration team, and that led to pilot training. We trained test pilots in the U.S. as well as other NATO forces that would come in with their test pilots for high-altitude supersonic operations. Satellite technology has dramatically changed over the last 20 years, and it's gone from the very large satellites to CubeSats, which was still a little bit big for us to be putting in orbit. And now we have what's called nanosats. And these are very small satellites that are currently operating in constellations around the Earth as we speak. We've come up with a different program as most of the launches, which is the standard launch that takes place. We are looking to launch these aerial rockets off of our fighter, which we become the first stage of the rocket. It gives us a lot of opportunities for flexibility. We can utilize the aircraft in more than one location. So if we're needed somewhere else to deploy these satellites, we can actually move to that location and do it very quickly. So from a DoD standpoint, they find us to be very enticing and obviously exciting for potential future. We're the only ones that are in the market doing this right now, as we have very high-speed fighters, which it takes for these rockets to be able to be launched and done at altitudes that are acceptable to deploying these rockets into low Earth orbit.
Rick, I don't claim to be anywhere near an expert on this, but my understanding is that the jets have weight limits, right? There's only so big a satellite they can carry. So how much are you limited by that, and how big is the market for the size of satellites that you can carry?
Well, it's kind of interesting you say that. We basically, we can carry a payload. We're carrying rockets that are up in the 1,500 pound range at this point. So the payloads are subtracted, obviously, from the weight of the rocket. And we are already in the process of looking for additional newer technology and newer capability, in which we've already started as we speak. The aircraft are Mach 2 plus aircraft, and that's a unique scenario. There's no operating Mach 2 aircraft, certainly from the corporate world. So we've got a huge head start on the rest of the market. There are other aircraft that we are already looking to add to our fleet, and that's going to give us that opportunity to, I think, create yet even a bigger and better opportunity for us to put these payloads into higher altitudes and ultimately low Earth orbit.
Well, Rick, congrats on the IPO. The stock, as we saw, it's been paused a bunch of times because of the volatility, because it keeps going up by so much. So we'll keep tracking it, and we'll catch up with you again soon. Thank you.
Thank you, Julie. I appreciate for having me on your show.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.